Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Normally, when the government gets involved with business, you expect it's going to be bad, or at least bad for the business in question. In this country, we like private industry to stay private, and we want its interactions with the federal government to be as minimal as possible, unless the company needs a bailout. Otherwise, just forget it. But that's not the way of this government. Certainly not when it comes to NVIDIA or AMD, as we learned today, which had Wall Street buzzing on an otherwise mixed session. Dow slipping 201 points, S&P declining 0.25%, NASDAQ edging down 0.3%. This morning, we learned that the U.S. government is planning to take a 15% cut on all the AI chips that these two companies are currently selling to China. For NVIDIA, that means a 15% cut on the H20, which was their cutting-edge chip for AI a few years ago, something they were previously banned from selling in the PRC. The president then said that NVIDIA might be getting approval to sell a next-generation chip to the Chinese, something, wow, more like their current version, Blackwell, except it won't have as much computing power. We didn't expect that Blackwell could be allowed in China. This was a big deal that the market completely just ignored. That was a mistake. The president had asked for a 20% cut of revenues, but NVIDIA CEO Jensen Huang bargained him down to 15%. That was good. The news was greeted as a total novelty, although it wasn't the first time this government has taken a stake to profit from its own moves. Not that long ago, the Defense Department took a 15% stake in MP Materials, the rare earth mineral company with a stock that subsequently doubled. Good trade for the country. We need these materials for national security, and an even better trade for the Defense Department, given that it caught a double. The cost to shareholders for the NVIDIA deal, as we told Investing Club members today, NVIDIA was selling about $8 billion worth of chips to China, that's every quarter, prior to the previous export restriction. A 15% haircut would equate to a little more than $1 billion per quarter, or about $5 billion per year. Hey, that's a big number for most companies, but not for NVIDIA. They were desperate to get this China business back by any means necessary. If the choice is between not having it or paying Uncle Sam a 15% cut, they're going to pay 15% every time. Many expressed outrage that President Trump demanded a return here. Given that business is, well, business, and the government's not supposed to get directly involved, right? I mean, it's certainly not your typical free market policy. Some even called it extortion. But from the perspective of big business, this is a great deal. Under the previous export controls, NVIDIA and AMD couldn't sell these chips to China at all. If they can get that business back in exchange for a 15% cut, that's a win for their shareholders. Granted, you probably don't want every policy decision to be made this way, but from the perspective of your portfolio, there's nothing to complain about. Or, to put it another way, we like to tell ourselves that we have a free market economy. But the federal government gets directly involved all of the time. Remember the CHIPS Act, the Biden-era program that picked semiconductor winners and gave them money to build the United States? I supported the CHIPS Act. But the big rap against this program was that the government might pick the wrong company to invest in, and that's exactly what happened when Intel got $2.2 billion from the feds after hitting some milestones, although it's not clear that Intel has completed anything. I did my part here. I was in favor of the CHIPS Act because our country had fallen so far behind in manufacturing semiconductors. That's bad for national security. But I also hated the choice of who got the money, practically begging the government not to choose Intel because the Intel of today ain't what it used to be. But in the end, the government winged it and got it wrong. That was really bad. This time, at least, the Trump administration is picking a pair of proven winners, AMD and NVIDIA, and getting taxpayer billions of dollars risk-free. At the same time, I want people to realize that there's nothing novel about what Trump did by taking a 15% cut of this Chinese semiconductor business. Taking a stake is something that the U.S. government has done many times. In 1979, when Chrysler was about to go bankrupt, the government took a stake, knowing that their investment would allow the company to make it. The government made $311 million when it sold off its stake in Chrysler years later. Or how about the Great Recession? At the time, the government was worried about failing banks, so it took big stakes in all of the majors to prop up the entire industry. Then eventually they sold these stakes off for a hefty profit. That, too, was a given. If the U.S. government invests in a bank, it's not going under. The bank is worth a lot more after the investment. Somehow the government failed to make money on its stake, and then it took into Save General Motors. But you know what? When I've looked into that, that was just bad trading. Finally, the government has repeatedly lost a ton of money to keep the airlines alive, most recently during the pandemic. But the whole industry tends to get a bailout every decade or two, it seems. Nobody minds these airline bailouts because we need an airline industry in this country. So there's nothing novel at all about taking a 15% cut. It's not like Trump collecting this money personally. It's not going to his library, for heaven's sake. That 15% goes straight to the Treasury. To take a 15% cut on their Chinese sales is basically just another form of tariff. And we've gotten a ton of those lately, so why not this? I'm not saying that the government's 15% cut of chip sales to China is perfect policy. There's an element of pay to play here that's definitely debatable. Although, again, pay to play is great for big business. I'm not saying it's what I would have done if I were president. I'm just saying that of all the ways the federal government has gotten directly involved with business in recent years, I'm calling this one the most benign. But let's take a step back a second. The government has gotten directly involved in business many times over the last 50 years. What matters to me is, did the government block something that it shouldn't block? Go back in time to when the president said that NVIDIA was not allowed to sell its lesser chips to China, something that hurt the stock, but more important, forced China to be able to develop its own AI chips. Letting them have their own AI chips is bad for us. It's not good. CEO Jensen Huang went to the president and pleaded that case. He pleaded it would be better for the U.S. if the Chinese were dependent on our AI chips. The software the Chinese would write on NVIDIA chips would keep them on NVIDIA for the duration. Trump didn't change his mind. Agree with Jensen. Or to put it another way, the government intervened where it shouldn't have, and then it changed course to do the right thing. That was the big decision that mattered, not this 15% tariff equivalent on these chips. That's the one that matters. The bottom line. Wring your hands all you want, but this chip deal is good for the taxpayer and good for NVIDIA and AMD. If the chip makers aren't complaining, why should we? Let's speak to James in Indiana. James.
Yes, Professor Cramer. First,
yes,
I want
James.
to say thank you for your insights on the market and stocks. It has made me money.
Yes,
today,
James, thank you.
Today, I wanted to ask you about Chipotle. I bought it last year in the low 50s, and it's down 20%. Should I sell or hold?
I am troubled. I am troubled by Chipotle. It hit a 52-week high today, a 52-week low today at 41. Something does. I think that Scott Boatwright should come on, and we suss out what's going on here, because I don't like the action and I don't like what I'm hearing. And yet I know that this is a place that I still like to eat. So I don't want to give up on it because I still like the product. Let's do a deep dive on this one. Let's go to Julie in Minnesota. Julie.
Hi, Jim. Thanks for taking my call.
Oh, thank you for calling, Julie.
I have a stock in my portfolio that has been a thorn in my side. I purchased it in 2021 at its very highest, obviously. It started to go down. I bought more to help cut my cost average. I'm still in red on this stock. I know they have a new CEO trying to turn things around, but what advice could you give me on PayPal?
All right, this is really important. I think that the PayPal CEO is going to figure this out. This is Alex Chris. He's very good. I do think that PayPal has a great business, but the price is great. You know, it's really top in buy now, pay later, which everybody's so crazy about. But I do think that Alex has got to start delivering, and he didn't deliver in that last quarter. I don't want you to give up on PayPal, and that's not out of hope. That's out of Alex Chris in the core business, which I think is still strong enough to turn around. Marilyn in Michigan. Marilyn.
Yes, Tim. I am a first-time caller, long-time listener. Here's my question. Berkshire B shares in an IRA, buy more, sell them all?
Buy more. I'm not buying this idea that this thing is Warren Buffett and nothing else. That doesn't make sense. There have been a lot of people working at that company for the last couple decades who've been integrally involved, and it has done quite well. So I think the answer is... All right, the chip deal today is good for taxpayers and for the companies involved. If they're not complaining, why should we? I heard all day complaints. Give me a break. On Made Money tonight, UL Solutions tests the safety of products that we use every day. So should you, I'm thinking about, should you buy the stock now that it's got hammered? I'm going to check in with the CEO fresh off the company's report. Remember, it has had very few price picks. Then you called and you stumped me on Symbotic. I've done the work, and I'm ready to turn in my thesis on the warehouse automation company. And then perhaps most exciting, and I mean really exciting, Cerence AI's technology is found in 50% of cars worldwide. I'm hearing more about how it's disrupting the automotive space with the CEO. And by the way, it's not just going to be the automotive space. I like this one. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What the heck just happened to the stock of UL Solutions when it reported last week? It's a global leader in safety science, handles all sorts of product testing, and until very recently, the stock had been a great performer. But when UL Solutions reported last week, even though their sales and earnings came in substantially better than expected, management only reiterated their full-year forecast. They didn't raise it, not even to compensate for their strong results. In response, the stock tumbled 11.5% in a single session. That was surprising to me. Since then, though, UL Solutions was able to recover a couple bucks. So was that initial sell-off merely an overreaction? Let's take a closer look, not just in the short term, but the long term, with Jennifer Scanlon, the president and CEO of UL Solutions, to find out. Ms. Scanlon, welcome back to Mad Money.
Thanks, Jim. Great to see you.
Okay, so Jennifer, first to get started, it was an excellent quarter, and a lot of things went right, even as some people were concerned about tariffs. Other people were concerned that maybe there was some short-term let's say, I don't want to say trouble, but issues involving data centers too. Maybe people got too excited. I have too. Can you clarify what really happened? Because I know that incredibly Baird came out and said guidance held, street disappointed.
We were incredibly pleased with this quarter. We had 5.5% organic revenue growth, a record revenue. We increased our EBITDA 170 basis points, and all of this was happening in a pretty dynamic manufacturing environment for our over 80,000 customers. So we were thrilled with results. But, you know, Jim, I think I've said this to you before. We're pretty good, solid Midwesterners. We're not going to overpromise and underdeliver into the future. And the environment continues to be uncertain for our customers.
Well, I know you know in an initial slowdown in customer projects when tariff levels were first announced early in the second quarter, as companies paused to assess the potential impact of tariffs, was something you said on the call. Perhaps that made people worried because then after that you said they came right back.
It's really important to separate the distinction of the effect of tariffs, which we, as we said all along, really have no long-term effects on tariffs. There can be a short-term bump, but long-term tariffs are pretty neutral for us. But to separate the effect of tariffs from the effect of uncertainty. And I think we saw our manufacturing customers take a pause in the month of May to assess what decisions they needed to make in this really dynamic, pretty challenging environment.
But then, because these are megatrends, electricity megatrend, data center megatrend, high voltage cable megatrend, they had to come back.
They had to come back, and here's why. I mean, just think about it. Data centers are growing 12% over the next 5 years. Electricity, and energy generation, which has been a pretty steady low single digit, is going to double or triple the needs. And all of that's supported by what we do: power and automation, wire and cable, the built environment that houses those data centers and makes sure that there isn't thermal runaway. The demand across all of our operating units based on these megatrends, it just continues, and it continues all over the world.
Tell me about the specialized stuff you do at a data center, because it seemed pretty interesting what you certify.
It really is. And there's over 70 standards that are written out there that we certify to in the data center space. So we can certify the DC current that's coming in through the much larger cables and ensure that those cables are not counterfeit. We certify those chillers that are wrapped around the data center. And interestingly, I know the Carrier CEO said a typical commercial building might have 2 or 3 chillers on the roof. A data center can have well over 100. The amount of cooling technology that's needed is tremendous. And then you just add in all of the building materials to ensure that it's not flammable. And then you get into the ways in which, the chipsets are used and benchmarked within servers and storage systems. It's just endless, those 70 standards that we test to.
Well, I know it's not just in the data center in terms of state of the art. We did watch a panel you moderated on quantum. Now, we know that if quantum comes, frankly, if quantum comes, I'd be very concerned about Bitcoin. They might be able to crack the code. How far are we away from having something that UL Solutions would have to review with quantum?
Well, we are certainly involved in every generation of technology, and we're excited about quantum. Today, quantum is about $1 billion of a market size, and it's expected to be over $850 billion in just 15 years. And so here's what's happening. The computing power and speed of the types of problems that quantum can solve are completely different than classic computing or even the way that AI computing is performed. And it's a different environment. Those quantum data centers have to be really cold, and they have to be motion-free. So there's a whole new set of ecosystems and environments that's required. And then you just get into, as you pointed out, the ability to crack encryption. What's the type of security that needs to go into those environments? And what's really exciting is that there are, old technology companies like IBM pairing with new technologies like PsiQuantum who are out there just innovating and building this entire environment for quantum.
Well, is this an example of what you guys do? I mean, no one would have thought, frankly, I have to admit, I didn't expect it. I'm sorry to interrupt, but I didn't expect to hear about quantum. But I imagine that when there's a new technology, you have to be able to keep up with what your clients want you to keep up with.
Exactly. And this is something, we've been involved with this for a couple of years now with these big companies who have been really thinking about what are the challenges? What are the safety challenges? What are the security challenges? What are the sustainability challenges? And like all new technologies, as we say, our customers tend to call us first to have us involved in the research, to have us involved in really thinking around those corners for the ways in which it could affect their customers.
Well, one last question. Are we years away? Are we 3 years away, 10 years away for when we should be talking about quantum quite regularly like we do AI?
Here's the thing with technologies is, I look back 35 years that I've been involved in technology, and what's old is new again. And I think many of these concepts around quantum have been in applications in a lot of different industries. And so it will be, I think, a rapid evolution in the near term, and it's pretty exciting.
Well, it's really exciting for us, too. Anyway, I'm really glad you checked in with Jennifer. I think that you said the right thing. You said, look, we're conservative. There's nothing wrong with being conservative. That's Jennifer Scanlon, President and CEO of UL Solutions, which is a very I'd say, great grower if you want to be involved with these technologies without being on the roller coaster. Thank you, Jennifer.
Thanks, Jim.
Mad Money's back after the break.
Coming up, Symbotic is aiming to revolutionize warehouse distribution centers with AI. But does that mean it deserves a spot in your portfolio? Cramer's sharing his thoughts next.
A couple of weeks ago, Brooks in Colorado called in to ask about Symbotic. That's an automation company with a red-hot stock. It's almost 120% up this year. Holy cow. I said I'd do more homework because I hadn't been following this one too closely. Now, this is an interesting story. Symbotic makes robots. The company used to automate warehouses. Everybody from Walmart to Target to Albertsons uses their machines. You might want to check out their website to see how it works. It's a whirlwind of robots that look like vehicles moving goods all around a warehouse. Smaller sorting and picking robots, conveyor belts, dense storage racks, all working in unison to get everything where it needs to go. This company was actually founded by a grocery wholesaler. The head of CNS Wholesale Grocers created Symbotic to help solve his distribution problems, then gradually started offering his technology to other businesses. In 2021, Symbotic announced that it would be coming public, not the regular way, but via merger with a SPAC, but backed by Japanese investment company SoftBank, real backer. The deal closed and the combined entity became Symbotic in mid-2022, just as the SPAC boom was turning into a bust. But Symbotic's a little different from many of the companies that came public via SPAC mergers because it has a real business with real revenues. The stock had some choppy trading through the first 6 months, but then went on a major run that lasted through 2023. Bye. That's around where we first started hearing about the company. In fact, I covered Symbotic in a homework piece. It was about over 2 years ago when the stock was at $26. I felt like we were late to the party given how much the stock had already run. Maybe that was too conservative, though, because the stock went on to double over the next few months. But then it got pulverized and spent the next couple of years in battleground mode. By the time Symbotic finally bottomed just after Liberation Day, it was back in the mid-teens. But now that the stock is hot again, I think it's worth taking a fresh look. First off, in the 2 years since we've covered this one, Symbotic's financials have improved dramatically. Their earnings before interest, taxes, depreciation, and amortization turned positive last year, and their sales have grown like crazy, from $252 million in fiscal year 2021 to $1.82 billion in fiscal 2024. That ended last September. Second, though, there are real risks here. For the past couple of years, Symbotic's been a frequent target of short sellers. Sell. The shorts argue that the company's tangled relationships with its largest customers could create problems. One of the company's large customers, for example, is CNS, the grocery wholesaler that's controlled by Symbotic's founder and CEO, Richard Cohen. There's also a somewhat close relationship with SoftBank, which started with the SPAC merger to bring Symbotic public. In 2023, SoftBank and Symbotic formed a venture called Greenbox, which essentially is a reseller of Symbotic's warehouse automation technology. They build it as, quote, warehouse as a service, end quote, offering. Then there's Walmart, which accounted for 87% of Symbotic's revenue last year. That's why it was so damaging when we got a short report last summer, which alleged that Symbotic had completed more of its work for Walmart than most people appreciated. And unfortunately, the company gave more ammo to the short sellers late last year when it disclosed that it had found errors in its accounting and had to delay the filing of its 2024 annual report. Sell. SoftBank and Walmart are also Symbotic's two largest shareholders, and Walmart has a substantial amount of warrants that could give it even a larger ownership position in the future. It got even more complicated when Symbotic bought Walmart's advanced systems and robotics business earlier this year. I don't know, frankly, I don't love all this complexity. It's very tough to follow and complicates the story to the point that some investors don't want to get involved at all. But at the end of the day, as long as Walmart's happy with Symbotic, and they seem to be happy with Symbotic, then all of this is not necessarily a deal breaker, but it is a risk to be aware of. So let's talk about this stock's incredible run from its April lows, from the mid-teens to the low 50s right now. Now, some of that's because the stock never should have been so low in the first place. Some of it's that Symbotic's a speculative stock with a high short interest. Get this, currently around 26% of the float has been sold short. That's gigantic, and it makes a pitch-perfect meme stock. But a lot of it's because the company reported an excellent quarter in May, even if management also gave tepid guidance for the next quarter. The stock rallied relentlessly for the next 3 months. Then last Thursday morning, Symbotic reported another very solid top and bottom line beat. But this time, there was some hair on the quarter. First, the free cash flow came in much weaker than expected. Second, management gave weak guidance for the current quarter. The company explained that it was redeploying some resources as it transitions to a new next-generation storage solution, and this transition would continue into the first half of fiscal 2026. But investors weren't having it. Perhaps because the stock had run so much going into the quarter, this time Symbotic rolled over, with the stock tumbling almost 14% last Thursday. And after a modest recovery on Friday, it got hit again today, down nearly 8%. So what do we want to make of this stock now that it's gotten hit? I'm a bit torn on this one. I like the technology and the growth trajectory. I just wish Symbotic were a cleaner story. I'm not super worried about the concentrated Walmart business, but at the end of the day, it's a problem when you get 87% of your sales from a single company. It's also tough to value the stock. If we use the consensus earnings estimate for 2026, then the stock's trading at over 150 times next year's numbers. If you use the 2028 estimates, Symbotic looks a little more reasonable, just over 25 times that number, but that's 3 years out. If you want to use a price to sales multiple, Symbotic trades at about 14 times this year's earnings, sales, and 14 times sales is far from cheap, frankly. Now, I wish the stock had more of a reason to more than triple. I don't know why it tripled from its April lows and its current level. That bothers me. A lot of this just feels like Symbotic can't lose in a market that loves AI or automated related, anything robotic. As long as that dynamic continues, the stock's a winner. But I don't like to recommend stocks for that reason. At the end of the day, I just don't feel comfortable enough with this complicated story to stick my neck out for Symbotic. If you're thinking long term and if you fully understand the risks and try to understand that short position, the concentration with Walmart, you got my blessing to speculate on this one. Just keep in mind, you're speculating. Here's the bottom line. Symbotic's a cool company. And if you're comfortable speculating, then you can put a small position on here and potentially buy more on weakness. But overall, I think there are more straightforward ways to speculate in this market. But it is cool. I'm not denying that. All right, let's go to Maggie in Missouri. Maggie.
Hi, Jim.
Maggie, how are you?
I'm very good, thank you.
Good,
I'm
good.
calling about Celestica.
Oh, Celestica's red hot. I like Celestica. I like J-Bill. I like Sanmina. All three of these companies what they do is they contract manufacture, and in a time of tariffs, you want to be where you can build something that you have a lower tariff, and Celestica can really help you. It is a strong buy. I've been trying to figure out how to recommend it on the show, and I'm so glad you called, Maggie. You just gave me the chance to do so. Let's go to Mike in Florida. Mike.
Hey, Jim. How you doing, big guy?
I am doing well, Mike. Thank you for asking. How about you?
Hey, just want to say a big fan. I just wanted to say you are an American treasure. Just want to thank you for all the great work that you do.
You're quite kind. You're quite kind.
Yeah. So here's my question about a company that has earnings coming up towards the end of the month. It's been on a decent run so a little bit lately here. How about Dell Technologies? What are your thoughts on Dell?
Dell's a buy. And I keep hoping, like, maybe we get a bad CPI number and we come in and buy, and I can recommend this thing hard. It hasn't had a break. You should see all the stock that Michael Dell bought back during the downturn. Remember, we came out very strong in the 90s and 100 and said when it was there, we had total conviction that Michael was the real deal, and he always been the real deal. I want to wait for a price break. I think you can get one before the quarter is reported in in August. But I will tell you, the more I do work on Dell, the more I realize he is every bit as great as he always has been. And anytime it goes down, you just buy. Anyway, I think there are more straightforward ways to speculate in this market than just Symbotic. Oh, but this is a cool company. So if you want to start a small position in it, I'm all for it. I wish they had like 5 big customers, though, not just so much Walmart. Much more made money, including my sit down with the former CEO of Intel. Hey, he's at a new cool company. I'm getting his take on the current state of Intel, now that it's drawn the attention/ire of the White House, along with, of course, what he's up to at Cerence AI. Ooh, you don't want to miss that one. Then I'm sharing with you why index funds won't make you rich alone, and how individual stocks like when I found NVIDIA are crucial to your financial freedom. And of course, order calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What does the next act look for Cerence AI, which makes AI-powered user interfaces for the world's leading automakers? The company was spun out of the old Nuance Communications back in 2019, and its stock caught fire in the early years of the pandemic. Like other AI plays, came right back down in 2022. Around this time last year, Cerence was far too small for me to talk about on air. Then last October, the company brought in a new CEO, Brian Krzanich, best known as the former CEO of Intel. And earlier this year, its stock soared when we learned that Cerence would be working with NVIDIA on its AI models for automobiles. Which brings me to last Wednesday, when Cerence reported a very good set of numbers, even if the guidance was, some people thought, more mixed. That breathed some new life into the stock. So what's next? Let's check in with Brian Krzanich, the president and CEO of Cerence AI, to find out his long-term plan. Mr. Krzanich, welcome back to Mad Money.
Thanks, Jim. It's good to be here with you.
Okay, so Brian, what's been the primary focus for the last 10 months? Because I know you've rebranded the company, but I wanted to figure out, with the rebranding, what has changed at Cerence?
Well, a lot has changed, Jim. I mean, as you can see, the financial performance has really improved, right? We hit it out of the park on almost every single parameter in the third quarter. And I'm really proud of what the organization has done. But what's also changed is AI everywhere. In every one of our products, artificial intelligence and really large language models are the key to the performance. And there are many large language models that are internal to Cerence that actually help differentiate our products to the end consumer. And everything we do now has large language models and AI built into it. We're writing code with AI. We're doing quality assurance with AI. We're doing language improvements with AI because we're in every country. So I use AI every single day of my job.
Now, I know when I was fooling around with your website, I was in a car basically with two other people, with people with heavy accents, admittedly. And one thing was absolutely clear. Unlike, say, Siri or Alexa, you could interrupt. You could interrupt and ask a question, and it was unfazed and went back and forth as if it's a conversation. Is that some of what the AI is at Cerence?
Yeah, that's really about agentic, right? It's a partner. It listens and talks to you just like you and I would talk, right? You can interrupt me. My train of thought keeps going. There could be two people talking in the room at the same time, 3 people, 4 people, and we can keep those conversations separate. And AI is getting to that same point. It has that ability, and it really empowers you in the vehicle.
Is that why, for instance, that Mercedes is a new partner? Because I felt that that's a pretty hard partner to beat, frankly.
Yeah. I mean, there's a few things that differentiate us in this industry. One, strong automotive experience. There's thousands of instructions that are unique to automotive that you have to have the artificial intelligence and the models and the history of the data sets to really run the car, right? Open the windows, close the doors, all of those kinds of things. But then the strong technology and the artificial intelligence roadmap, we showed them that we're on an annual cadence of bringing in new technologies and new capabilities, things like measuring your emotions, using the cameras in the car to read street signs and billboards as you're driving down. You pass a billboard, you could ask the car, hey, what was that billboard that I just passed? The car will have read it. That whole roadmap is what they bought.
Yeah, I saw that. I was surprised. I mean, you could say, you dial that number. What was that number on the billboard? And it was incredible because it makes it so that if you catch them in their eye, you can focus on driving, but you can ask questions without turning around, without looking around. So it's got safety as the chief component.
It does, and it's like having another partner in the vehicle, right? That's really where we're headed. It's a partner in the vehicle helping you drive, asking, do you want me to call that restaurant for reservations? Do you want to, navigate to your work today? Because I noticed it's in the morning. And hey, if you ask it what that billboard read, it will give you that information.
Now, you went to CDK after Intel, which was a huge win for shareholders. I mean, what's the long-term goal here for Cerence AI?
Well, to me, the long-term goal was I kind of had a multi-year goal in coming here. First was get it financially stable and really get it back to the growth. I think we're there. The last quarter really represented that. The next thing is build a multi-year technology roadmap that brings agentic nature to the vehicle. And third is to start looking for areas outside. You saw we also announced, for example, our partnership with LG for their TVs, right? We brought our voice technology and our large language models to the television with LG. You can now just hold up your remote and say, hey, tell me all the movies with Tom Cruise in it that I can watch right now, or whoever you want to talk about, right? You could ask it questions about a movie you're watching. We are bringing that technology to other devices.
Yeah, I love that. Hey, but let me ask you why I've got you. I'm sure you know Lip Bhutan. Everyone in the industry knows Lip Bhutan. He's been a chief sponsor of semis when everyone else was doing enterprise software. He knew to stay with semis. Very few didn't. Tough that he's being called on the carpet by the president. I remember in 2022 when he got the Noyce Award. He's probably the most distinguished person in semis, and it seemed odd to me that he got called out as perhaps not a patriot. I don't know where you come down on it, but I think you probably know him. He's a pretty distinguished guy.
Yeah, I mean, I think we've all, like you said, known Lip-Bu for years. And I think from a technology and leadership position, he's unquestionably a strong, leader who can really, take a company. Cadence was a good example of what he was able to accomplish there. So, yeah, I have great faith in Lip-Bu.
All right, that's terrific. Anyway, I have great faith in you because you that CDK, which you told me would be a home run. And I was like, but it sure was. And this one is clearly a great turnaround. Brian Krasanis, President and CEO of Cerence AI. Brian, thank you for coming on the show.
Thank you very much, Jim.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Please say it. Talk about my myself. So don't know the course. Talk at the time. My staff person. Plan this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Lou in Pennsylvania. Lou.
Hi, Jim. I agree with you that the market overreacted last week to the weaker than expected data for the oral form of Mounjaro, but others are beginning to buy the dip for Lilly. You too, or give it more time just to let it
look, I got a meeting Thursday for the investing club, a noon meeting, and I'm going to talk about Lilly. Down here, I begin to think that we are too negative on it, but I am very upset with Lilly and the way they handled this, and I think they should come back on and talk to me because I'm running a drug trial. I would not have done what they did when I was running my drug trial. That's a private matter, but I can tell you about it. It's not the way they did it. I think they knew better. They shouldn't have done it the way they did. Let's go to Dave in Illinois. Dave.
Dr. Cramer, my good mad friend, how's your tomato crop this year? Getting ready for your none better sauce?
No, Canada, I got to tell you, Dave, because we didn't get enough sun, the crop is much shorter than I expected and not as fecund.
I hear you. This $23 billion market cap stock operates in the buy now, pay later space. This past May, they delivered some incredible results, after which you commented, I suspect this streak will continue. On the brink of reporting next quarterly earnings of Affirm Holdings, I expect confirmation of your bullish view. Jim, your thoughts?
Dave, it's at 72. It's gone 100, okay? Now, I usually don't talk like that, except for I talk like that with Palantir. 72 goes to 100. I say get on board Affirm. Yes, get on board Affirm. Let's go to Frank in Iowa. Frank.
Yes. I bought BBG and I'm thinking I ought to buy a bunch more of it. It sells for less than book price and has 8 PE and pays 7% dividend. I can't understand why it's so cheap.
Which one was it? Oh, Banco Bradesco. I'll tell you, I don't want to be connected with Brazil. It's had a big run. Can I just substitute, if you don't mind, and say if you want an overseas bank, I think you should be in Santander. Now, it just hit an all-time, 52-week high again. Doesn't have as good a yield, but it is crushing it. It's the biggest bank in Europe. I think Santander is a little bit better. I don't want to be connected with Brazil. I really want to be connected with Spain. Let's go to Akash in Michigan. Akash.
Hey, Jim. Congratulations on 20 years. I'm a huge fan.
Oh, thank you. Very kind. Thank you.
I wanted to get your opinion on a Root insurance.
I know Root. I think that Root, Root, and by the way, Lemonade is the one that I'm looking at for when it comes to insurance. Lemonade is your play. And by the way, I think Lemonade is disrupting the industry to the point where we're seeing lower rates possibly. I know that because we're seeing a lot of insurance companies talk about lower rates, including Berkshire Hathaway. Now we're going to go to Kevin in Georgia. Kevin.
Hey, Jim. Hope you're well.
I am doing well. How about you?
Good, thanks. Good, thanks. My stock has price targets ranging from $724 to $1,500. Could you offer some short-term and long-term guidance for ServiceNow?
Okay, ServiceNow short-term is being hurt by a call out of Melius, and that's by Ben Regis, who is saying that these software as a service companies are going to be under pressure because of their seat models and can be hurt by AI. I think longer-term ServiceNow has really good AI, and it would not be a stock that I would want to bet against. So ServiceNow, longer-term, I think is fine. Shorter-term, I think it's be under pressure. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's breaking down why stock picking should be an essential practice for every investor. And he's using none other than NVIDIA to make his case. Next.
So this weekend, I'm walking around in Summit, the town I live, and I'm stopped by an old friend from the days when his daughter and my daughter used to hang out. After some chit-chat about our kids, he told me that he had some good luck in the market. Apparently, he watched Mad Money, and he heard that I renamed my dog Everest, yes, NVIDIA, out of sheer frustration at the fact that nobody was paying attention to it. To NVIDIA, that is, not my dog, who was a real ham. My old friend knew I wouldn't make that name change if I didn't have conviction that NVIDIA stock was headed higher. He said he'd made almost $1 million in NVIDIA, with some gains already taken to avoid being a pig. Then he said something important. The stock market can be such a wealth creator. It's incredible. You don't need to work at the company. You don't need to know the industry all that well. You can just look at the business, invest some money, and make a lot of money. I couldn't agree more. My friend hadn't seen my new book, which comes out next month, How to Make Money in Any Market. But if he had, he'd know that these were my sentiments exactly. Sure, it sounds like a no-brainer to buy NVIDIA in hindsight, but there were two big obstacles to doing so along the way. First, without someone vouching for it to the extent that I did by naming my dog NVIDIA, it seemed like just another semiconductor company at a time when semis were regarded as second class and everyone just wanted enterprise software. Boy, those stocks are awful. Semis have been a wasteland for venture capital, while enterprise software drew all the money. Therefore, it got first dibs for the public's money when a company came public. So enterprise software got the money because they kept making so much money when they came public. Semis didn't. Second obstacle. This is a point that it's the heart of Mad Money and how to make money in any market. Individual stocks are crucial to becoming wealthy. But the financial industry always tells people that they should own only index funds. That's the conventional wisdom, because individual stocks are considered to be too risky, and it's hard to pick winners. It's much easier to just try to mirror the market's overall performance with an index fund. Now, there's some truth to that, which is why I see the value of an index fund for diversification. It's nice protection against picking a bunch of clunkers. That's why I recommend putting half of your savings in index funds. But I also favor putting the other half in individual stocks of your own choosing. You can own speculative stocks. You can own stocks that you really love. You can own stocks with big dividends that can compound over the years. I don't care. And you can pick NVIDIA. Put simply, there are so many NVIDIA millionaires who watch this show or belong to the CNBC Investing Club that it would be insane to rule out owning individual stocks. Now, you won't always get them right, but when you do, that's where you rack up the big gains. Frankly, there have been way too many stocks like NVIDIA over the years. Okay, not quite as good as NVIDIA because that's the absolute best performer since it came public. But you could have bought a stock from FANG or FANG. Those were what I call gettable. You could have bought Apple or Netflix or Facebook, which only became Meta. These are not hard to find. They're right in front of you. The only thing standing in your way is the orthodoxy that says you can't listen, you can't learn, and you can't buy. Shame on those who tried to keep you out of NVIDIA. And there were many, including the myriad talking heads, who say what happened with NVIDIA is impossible. People, it happened. And you're welcome for those who thank me. But, of course, the real thanks belong to NVIDIA's Renaissance Man CEO, Jensen Huang. I'd like to say this always bull market summer, and I promise to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.